welcome Laura Hardy, Assistant Vice President and Division Underwriting Counsel for Old Republic Title Company. Please welcome Laura.
I like that. I like the disclaimer. I'm a lawyer, so I appreciate it. Mark is getting my lovely presentation here set up with this annoying low clock. Obviously, this hasn't been updated since last Wednesday, I believe it was, when we found out that we get an extra 2 months before all of this kicks in. However, I don't think anything's going to change substantively in those 2 months. So without further ado, I'm going to talk to you a little bit about, I'm sorry, I promised Rhonda. I'm Division Underwriting Counsel for Old Republic National Title Insurance Company, but I'm also counsel for Old Republic Title Company of St. Louis. We have an office out here in St. Peter's. I think you guys all know Rhonda. She's our ebullient, is that a good word? Marketing representative for our St. Peter's office. And if you have any questions about services out there or any of the products, things we can help you with as this transition moves on, please contact either myself or Rhonda. We have business cards back there, as well as some other informational materials. So this is set to autoplay, so it may get ahead of me.
No.
No?
You need to click.
Okay. So the first thing I'm going to talk about is the Consumer Financial Protection Bureau. Who knows what that is?
Yeah.
All right. So I thought I'd start there, since they're the ones making all these lovely rules for us. The Dodd-Frank Wall Street Reform Act that was enacted in 2010 created the Consumer Financial Protection Bureau. They're under the Federal Reserve technically, but they're an independent bureau. They took on the responsibilities of numerous different divisions. The Federal Trade Commission, the Federal Deposit Insurance Corporation, the NCUA, National Credit Union Association, and HUD. So they basically were charged with creating regulations to protect consumers in all sorts of financial transactions. The whole idea being to promote stability in the financial markets to avoid a real estate mortgage situation like we had in 2008, 2009. The interesting thing about this, the director is Richard Cordray. Anyone see him on Jeopardy? It was unimpressive. He finished in the red. Not a good sign for the government. So the CFPB is entirely fine funded. They are not, the Congress does not budget for them, which means they have an incentive to fine, because otherwise they have no money to operate. We have seen all kinds of different fines as they're charged with all sorts of different regulations. I'm going to make this an autoplay. So they basically took over enforcement of RESPA and TILA from HUD. So they now have the authority to set the fines for those things, to conduct the investigations. The other thing they were charged with doing was basically consolidating all of the closing documents, reformatting them so that they're, in theory, easier for the consumers to understand, so that the consumers had more time to shop for loan products. They're trying to push that again, like they did in 2010, and to really understand what they're signing up for with the loans. Whether or not, it will work, we'll see. Okay, so without further ado, into my little presentation here. So the majority, these new closing disclosure rules affect the majority of closed-end mortgages. So that's your residential 1 to 4 family transactions. It's also going to cover some loans on ground over 25 acres, vacant ground. It's basically anything except these items here: reverse mortgages, HELOCs, mobile homes, and that means a mobile home where the mobile home is the only collateral for the loan and it is not real property, so basically not anything we deal with. Commercial loans, creditors making 5 or fewer loans per year, so if you have a seller take back, that won't be subject to this. Certain no interest subordinate special purpose loans, that would be like a city or county grant money for down payment, basically like a buyer incentive program. And so obviously this date has changed a little. The CFPB came out last week and said, oh, we made a mistake. We missed this deadline by 2 weeks. You have to, apparently, every regulation that any government entity puts into place has to be filed with the government administrative office 60 days before it can take effect. CFPB, oops, forgot to do that. And so they were going to have to delay it at least 2 weeks. They took that opportunity, thankfully, and said, we're going to go ahead and delay this until October 1st, 2015. So these rules apply to any loan application received by the mortgage broker or lender on or after October, I said that so many times, October 1st, 2015. They haven't announced any changes to the rules. We don't know if they're going to announce any changes to the rules in that time. They also have not announced a soft enforcement period. People have been calling for them to give a 6-month period basically for the industry to get adjusted to these new rules. With them still investigating people but not finding them as long as they're trying in good faith to comply with the new rules. Up until recently they have said absolutely not unless we have an active Congress saying we have to. So they're going to be really great to work with, I think. So this is a little, sorry, I'm a little deadpan sometimes. So this is a little bit more about the power to enforce the rules. So this is TILA, RESPA, and these new regulations. They promulgated the qualified mortgage rules for lenders. So these are the fines, the dollar amounts we're talking about. $5,000 per day per violation, $25,000 per day for reckless violations, which is a legal term of art I won't bore you with, but basically if you're not really trying that hard to comply, $1 million per day per violation for knowing violations. And so just to give you an idea of some of the types of things that the CFPB has authority for, I just pulled a list of basically headlines involving CFPB fines this morning. I just Googled it. CFPB fines Regions Bank $7.5 million for unlawful overdraft practices. CFPB and FTC fined Green Tree $63 million for, quote, mistreating borrowers, unquote. CFPB fines GE Capital $225 million for deceptive credit card practices. CFPB fines mortgage company $20 million for pushing customers into spending more than they had to. CFPB fines lender over expense accounts. U.S. regulator, which was the CFPB, orders PayPal to pay $25 million in refunds, fines. CFPB fines medical debt collector for handling of disputes. CFPB takes action against Realty South for mortgage disclosure violations. That was actually a mortgage company and a Berkshire Hathaway brokerage that they had their affiliated business disclosure statement as is required by law in their documents, but it wasn't in all capital letters. And so the broker had to pay $500,000. The CFPB is a public entity. It is a government entity, but it's independent. It operates on its own. They supervise themselves. They're fine funded. So there's been a little bit of congressional chatter about changing that, but so far nothing's happened.
Where does that money go once they find it?
Back into their coffers. Some of it though, if they do refunds, so a lot of these are refunds plus fines. So in theory, a pro rata, a portion of that would go back to the borrowers, consumers, whoever's harmed by these actions, and then part of it, the fines go to them. So, yeah. The CFPB settles action against land developers for violation of Interstate Land Sales Act. I didn't even know that existed. I'm a real estate lawyer. CFPB targets another mortgage lender for deceptive advertising. So you can see kind of just based on what they're fighting for, they have very broad authority. And right now they're sort of operating without a lot of supervision. So people are concerned, especially since they have said we're not going to give a soft enforcement period for these new rules. So, hopefully this won't all be really scary. I don't know. My presentation here, I can't figure out how to not autoplay it, so I'm going to go backwards here. So one of the major changes is lenders, the loan estimate basically replaces the GFE, okay, once these rules take effect. And they only have 3 days once they receive an application to get that loan estimate to the consumer. It's going to tighten up their timeline a little bit because there used to be a catch-all category in what constituted receipt of an application, which was anything else the lender deems necessary to process the application. That has gone away. So now once the lender receives the name, address, estimated value of the property, income of the borrowers, their social security numbers, and loan amount sought, they have received a loan application, and they have 3 business days to get the consumer the loan estimate. Another thing that has changed a little bit is the loan estimate shows homeowners association fees, seller credits, home warranty charges, and homeowners insurance charges. So within 3 days, they have to gather estimates for these things, include them on this form, and get them out to the borrowers. So the rule actually recommends that they rely on real estate professionals, that'd be you guys, and also title companies to get them some of this information. So, you know, I can tell you, for example, Old Republic Title of St. Louis, we are putting together a database of homeowners association dues that we can, you know, as we collect them for various closings, we're keeping a log so that hopefully we can provide those. But that's something we're going to be looking to you guys and the lenders, your buyers lenders may be looking to you guys for those fees very early on in the process. So it may be something you want to have on hand if you recommend a certain home warranty company often. That's something they'll be looking for much earlier than usual. They only have, the lenders only have 6 reasons they can issue a new loan estimate. So information provided by the consumer was inaccurate, makes sense. Extraordinary event like tornado, fire, bankruptcy, something like that. Discovery of new information specific to the consumer or the transaction. Again, that might be, catastrophic damage to the property, bankruptcy by the borrower, something of that nature. A revision is requested by the consumer. It can be reissued on the day of locking the rate and after the 10-day expiration. So every loan estimate now has to remain open for 10 days. And then during those 10 days, the idea is, the borrower is going to go to other banks and say, hey, I got this great loan estimate from Community Bank. What can you do for me? And so the idea is to help them shop, to leave that 10-day window. Now again, whether that will actually happen, I don't know. The CFPB, if you go to their website, they actually have a section about how to shop for a mortgage. Like, I have my loan estimate, now what do I do? So they are really trying to push that. Now this relates to the actual closing disclosure. So the closing disclosure is the new name for the HUD-1, basically, and the final TILA disclosure. They're combined into one form. So in a lot of ways, the closing disclosure mirrors the loan estimate, just like the GFE mirrored or the HUD-1 mirrored the loan estimate. A lot of the categories pull over. I'll say it's a slightly more attractive form that was very expensive for all of the underwriters to update their software to show. It's I do think it's a little bit clearer because it has the, the summary information, the stuff the buyers really want to see on the front page, versus the current HUD-1 where you got to flip back and see what exactly is going on. But basically, the preparation and delivery, the way the final rule came down, the lenders can rely on settlement companies like Old Republic Title to prepare the closing disclosure for them and also to deliver it. However, they remain ultimately responsible for what the settlement companies do in terms of delivering those documents, closing the transaction. So there's a lot more oversight and a lot more pressure from banks on the title companies to, basically have a system in place for all of these things. So what most of the major lenders have done is say they are going to be responsible for preparing the closing disclosures. And so, basically title companies and the major banks are going to have software that kind of talks to each other, where the title companies will be able to go in and put in the fees we need to give them. They'll go in and put in all of their loan information because it does contain a lot more detail, a lot more numbers, a lot more details about the loan than the current HUD-1. And then they will be responsible for delivering it. So this is going to be the biggest change in terms of closing timelines. Have you all heard about the 3-day rule? The 3-day rule. So basically the borrowers have to have their final closing disclosure in hand 3 business days prior to closing. In reality, it's not 3 days because there's a presumed amount of time it takes to deliver those forms to them. So let me go. There's a nice little slide that has a timeline and this little dancing man. Sorry, I'm like, this, in case you're wondering, this podium, everything slides off of it. That's weird. Okay, maybe I'm stuck in the dance. But basically, in the rules, it states, well, when is it delivered? What does it mean for them to get it 3 business days prior to closing? Hand delivery to the borrower, so not to their spouse, not to their adult child, not to the receptionist at their office, to the borrower. If you deliver it right away by hand, they can close 3 business days later. So you deliver it on Monday, they can close on Thursday. Doesn't matter what time on Monday, you can close anytime on Thursday. U.S. mail, it's assumed they receive it 3 days after it's placed in the mail. So you put it in the mail on Monday, Tuesday, Wednesday, they receive it, then Thursday, Friday, Saturday. Saturday is a business day under this rule because most banks are open, even if their mortgage division isn't, on Saturday. Then you can close Monday. So you got a full week lead time for everybody to have final figures. Email is complicated. It's basically the same rule as mail, unless you get confirmed receipt prior to 3 business days. Okay, so it's assumed that it takes them 3 days to open their email, unless they confirm, after 1 day that they've gotten it. Also, to even be able to send documents by email, they have to have already consented to receiving documents by email and provided an email address. So my thought is most lenders are going to be including that sort of form in their loan application, saying I consent to receive, if they're going to use email, I would consent to receive documents by email at this email address. It wouldn't be the worst idea ever for you guys to include that, get that form signed as well when you're drawing up a contract. This is a nice little graphic. So the other thing I'll mention is we didn't print out all these slides because I didn't have a final head count until too late for me to print them out this morning. So if you would like a copy of these, we can certainly get that to you. Just make sure you pick up one of our business cards and email us or give us a call. We're going to put together lists and send them out. So you can have this for reference. But I will say that the top 10 things to ask your realtors is a good resource of the things that are relevant for you guys about the changes. So this basically lays out, sort of a little timeline based on how you're sending items. The major lenders have said they will send things by U.S. mail. So that means 7-day lead time on anything from Wells Fargo. In terms of just actually sending it out, it will be 7 days ahead of closing. Citibank, their latest bulletin said they want final figures 12 days prior to closing. Most of the big lenders are wanting these things at least 10 days in advance so they can get it out 7 days ahead of time. So it's definitely going to change our timeline. And that's something to keep in mind too when you're setting your period for closing. 30 days probably isn't going to be realistic anymore. Okay, so originally, this is a small victory. Originally, when they proposed the rule, they were saying any change at all to the closing disclosure, the figures, would trigger redisclosure, meaning you'd have to wait basically another week to close because you'd have to redo everything, resend it. They changed that, then they changed it to be anything over $200. Everybody also thankfully commented and protested and said that it was ridiculous and unreasonable and will basically slow the consumer housing market to a halt. So now there are only 3 things that can trigger redisclosure: an inaccurate APR, a change in the loan product, so adjustable rate to fixed or vice versa, something like that, and if a prepayment penalty is added where there wasn't one before. So even though these are the only things that require redisclosure and waiting, the waiting period required under the rule, the thing to keep in mind is that in most cases, the lender is going to be the one responsible for preparing the final closing disclosure. So anything that comes up, any adjustments based on inspections, things like that, are going to have to be communicated to the lender. They're going to have to be able to approve the closing disclosure. So there will still be some delays involved with any kind of changes to the final figures. The other thing is there's another rule in place, separate from the closing disclosure rules, another federal rule that the borrower must receive a copy of their appraisal at least 3 business days prior to closing. So if there's an event that changes the value, you may have to wait an additional 3 days for the appraisal to be redelivered. So, like we said, initially we were thinking 7 to 10 business days, but like I said, everything we've gotten so far from Bank of America, US Bank, Wells Fargo, Citi has been 10 to 12 days ahead of closing. And so, basically the thing you guys can do to, convey to your buyers is, as soon as the creditors ask you to do something, as soon as the lenders ask you to do something, it's in your best interest to do it as quickly as you can. Sellers, they have to comply with all the terms of the contract, because if you are making adjustments for things like the drapes, they were supposed to leave the drapes, now they took them with them, you're going to have to get that approved by the lender because they're the one preparing the statement and ultimately responsible for what it says. So, and we don't know, the various lenders may actually have, restrictions on how far out they'll let you do those types of changes. I haven't heard anything about that yet, but that may, they're still getting the ball rolling on this too. And I think that would come through at the time that your borrower is applying for a loan potentially. So everyone in the title industry is appalled at this. And it is, I think it is a bad thing. They require, because the closing disclosure is so loan-centric, it's really focused on making sure people are understanding what they're borrowing money for, what it's really going to cost them. They require that the owner's policy of title insurance be marked optional. It actually has to say on the loan estimate and the closing disclosure, title, owner's policy, optional. And so, in Missouri, Old Republic, and I know all the other major underwriters, we have a simultaneous issue rate. So if you buy an owner's policy and then you get a loan policy as well, which your lender is requiring, it's only, like ours, for example, is $135. Well worth it, because if you only buy the loan policy, the buyer is not in any way protected under that policy. If something happens with the title and they try to make a claim, it gets denied because they're not a policy holder. So, and it's really easy when you're looking down that form and you see origination fee, $1,500, flood fee, $10, appraisal fee, $350, and then you see something marked optional to be like, wait, I don't have to pay for that? Obviously it benefits us if they have an owner's policy, but we do get claims where people call and it's a total, we had one last week, there was a forgery, pure forgery in the chain of title. That's something we consider business risk. The agent had done everything they could to, verify the documents. They hadn't done anything wrong. They hadn't missed anything in the chain. It was just a pure forgery back in the chain. And the person who, the fraud was committed against, the actual owner, came forward and sued for quiet title. And the owner had not gotten an owner's policy. So it was a total loss for them. They lost all of the money they had paid for that property. They lost the property. So it's one of those things where, it's a cost-benefit analysis. Yes, it's an additional cost, but it's a great benefit if you ever do need it. We're hoping you guys will partner with us some and explaining to them what an owner's policy means. Obviously you don't have to tell them, yes, you need to buy it, but if it were me, I would not tell them not to buy it. If something like that ever did happen, you don't want them to be coming to you and saying, well, I didn't think I needed this. You told me I didn't need this. Especially you don't want to have that in writing to them. So. The interesting thing about this is that, the whole idea is to protect consumers, protect consumers, protect consumers. They don't care very much about the seller as a consumer because they don't have to get their closing disclosure at all before closing. So basically all of these rules are in place to protect the buyers. There will be a separate seller statement. I mean, I know now it's customary here to do, a separate seller HUD and buyer HUD. They're actually two entirely different forms now. My presentation's getting ahead of me again. So one of their big things, there being the CFPB, is the protection of non-public personal information. And so the lenders are basically responsible for the protection of this non-public personal information. So we, as title companies, as providers to those lenders, are also responsible for protecting that non-public personal information. NPI, as they're calling it, includes things like the name and address of the borrower, the birth date of the borrower, the social security number of the borrower, any tax or divorce info, which we frequently have to look at in a real estate, consumer real estate transaction. So those things are not shown for the buyer on the seller's statement and vice versa. So if you call the title company you close at and say, I need a copy of the borrower's closing disclosure, they're going to say they can't give it to you because in the form itself, it contains social security numbers, all of that information. And it has to be completed that way. So you'll get there'll be a separate statement they'll be able to provide you, or if the seller themselves or the borrower themselves say, yes, they can have a copy of this, then you can get a copy of it. But just something to be aware of. One of the other things that we're doing, because the lender is now directly responsible for certain actions of settlement providers, the title companies, there's been an industry-wide best practices set of standards promulgated by the ALTA, the American Land Title Association, which is our national trade organization. And basically, it covers all of the points that the lenders are concerned about. So the title companies you're working with are also have been working, I won't say working now, have been working on preparing a best practices manual for lenders for the last year at least. And that'll address things like how we protect the physical security. So like having a clean desk policy. We're going to have files locked up at night so no one can be near them. What all of the information security measures are that we take. So there's a lot of that that's been happening behind the scenes. And so your agents are everybody's prepared for that aspect. So just so you know, those are some of the additional measures we have in place for protecting non-public personal information. Really rolls off the tongue. So with any good government regulation, they have to just change all the vocabulary just for the sake of making it feel like they did something important. So the GFE is the loan estimate, or the LE. The HUD-1 is the closing disclosure. However, recently you may have heard people calling it the TRID, the TILA-RESPA Integrated Disclosure. So the CD, or the TRID, is the closing disclosure form, what basically contains the information of the final TILA disclosure, or TIL, some people call it TIL, Truth in Lending Act disclosure, and the current HUD-1 statement. So I'm going to show you the forms a little bit. I'm not going to go into too much detail with them, but just so you are familiar with them. And one thing I will say, if you are interested in seeing more examples of forms, or just have general questions, the CFPB has said it is not going to prepare an FAQ. I guess just to be difficult. So HUD prepared an FAQ when they released the 2010 HUD, which was very helpful if you had certain questions on what went in what line item, what could be labeled what. The CFPB is not going to do that. However, they do have a questions, comments, email link on their website. And they also have samples of refinance only forms, blank forms, completed forms, buyer forms, seller forms, everything that you can kind of poke around and see what's what. Now this is pretty tiny on this screen, so let's see if I use my fancy pointer here. So a lot of this looks exactly like the loan estimate. Okay, so up here you've got all of your non-public personal information. The date it's issued, the closing date, disbursement date, the settlement agent's file number, the property address, the sale price, which even in a refinance it'll be with loan amount. Okay, you got your borrowers and their address, sellers and their address, the lender. This rule, by the way, is 1,800 pages long, and in all their examples, they use Ficus Bank, the name of a tree. I think that's just kind of mean. Killed a lot of trees to get to this point. So, the loan term, the purpose, the product, loan type. So you can see already there's some more information here. The loan ID, MIC, that's the mortgage insurance case number, if there is one. Loan amount. So everything here is yes or no. But you'll notice if it says yes, you have to show your work. You have to explain why it's yes. Okay, so no, the interest rate is fixed rate, so no, it can't increase. Monthly principal and interest, okay, is just that, principal and interest. And here, do you have a prepayment penalty? Yes, and then you have to explain what it is. Balloon payment, no. This will look different on the various closing disclosures you have. There can be up to 5 columns here. Basically what the lender has to do is show the calculation for any changes in loan amount. So here, years 1 through 7, there's mortgage insurance of $82.35 a month. And so you have this number. Years 8 through 30, no more mortgage insurance, this lower amount. So if you have an ARM that can adjust, say, up to 2 points a year, you have to assume worst case scenario and then show what it will be in 5-year increments. So, in 5 chunks, basically, 5 periods of time. And the lender, this is why the lenders have chosen to prepare these statements in most cases versus the title company, because we're not making the loans, we're not necessarily privy to all of the details on that, and so it's a lot less likely for them to make a typo or put something in the wrong column than for the title companies to do it. So another thing to note is here is your escrow, okay, which is usually just your taxes and insurance. This here is your taxes, insurance, and assessments, homeowners association dues. So in most cases, those are not held in escrow. So this number is this number plus HOAs. Here you've got your closing costs, okay, what they're bringing in terms of fees, and then this is the cash to close. So basically your first page is more of your summary versus the current HUD one, which is all the itemized debits and credits. Here's where it gets really tiny. Origination charges, you'll always see points at the top, even if it's 0, it'll say 0 points. Then there will be all of the loan costs in alphabetical order. Everything's in alphabetical order in each one of these subheadings. B, services borrower did not shop for. So under the new rules, the lender has to provide a list of potential providers for all of the items it's requiring. So homeowners insurance, as well as a title company. So if the interesting thing is, if the borrower chooses one of those from the list, it is subject to the zero tolerance category. It's considered a service that the borrower did not shop for because it was on a list that the lender provided to them. So that'll fall in your zero tolerance bucket. So here you've got appraisal, credit report, flood, your typical things in alphabetical order. You're now showing things that are paid outside of closing. We have at closing, before closing, and then paid by others. So if anyone else pays for something, it will show in this category here, whether it's at closing or before. And if it's paid by the lender, there will be a little L in parentheses. Otherwise, it doesn't have to say who paid for it, just so you know. C, services borrower did not shop for. Pest inspection survey. So what you'll notice here is these title things only apply to the loan policy, okay, because the owner's policy is not considered a required cost of the loan. So it's going to show up in other down here, okay? So this is includes the title fees for the loan policy here. All of this totaled together, that's your loan costs, okay? Recording fees, these are, the straight charge-throughs from the recorder's office, so that's pretty much all it's going to be in Missouri. Some states have mortgage taxes, recording stamps, that would also go there. Prepaids, your initial escrow, your insurance, homeowner's insurance. Here's the initial escrow here in a separate, but again, all alphabetized, nice and neat. Other, this is where your commissions will now show up, as well as owner's policy title charges. So down here, real estate commission to broker, real estate commission to broker.
That's the important part.
Right, just so you all know where to look, I know. So the interesting thing about this, somewhere in here, there shows a rebate. Oh no, it's on the next page, I think. So anyway, so this shows your total other costs, okay? Here you've got your loan costs, your other costs, you add those together, those are your total closing costs. I think that big green arrow was to point out where your commission is, for the record. So this is similar to page 1 of the HUD one, but it's page 3. So this itemizes all of the debits and credits. This is where the tolerance, any tolerance violations are explained. This is the comparison to the loan estimate. So the lenders have to cure any tolerance violations within 30 days of closing, and then issue a new closing disclosure, a corrected one, to the borrower within 60 days of closing, in case you have that come up and are nice and helping them out or something. So you can see all that itemized here. Here you've got what's due from the borrower at closing, your sales price, the closing costs, any adjustments. This is pretty similar to what we already have. Okay, things that were already paid. This is my favorite. Other credits, rebate from Epsilon Title Company. That's a RESPA violation, and the CFPB is allegedly in charge of enforcing RESPA. So just to show you they really know what they're doing. It's going to be interesting. So here you've got, your calculation of cash to close from the borrower, what's going to the seller. Now this page 4 and page 5 are more like the final truth in lending disclosures. There's a lot of loan information here. Again, things that title companies didn't really want to be responsible for disclosing, and that the lenders have said, no, we prefer to handle these things. So things about assumption, whether it can be called on demand, which when I've talked to lenders, they say that's absolutely ridiculous because pretty much any consumer loan can be called on certain events, and so they think this is just going to scare everyone because it will show up on, it will say, yes, there is a demand feature on almost every loan. Late payments, negative amortization, whether they'll take partial payments. Then I like this, you're granting a security interest in, and it lists the address so they know. Escrow, details on the escrow. Here, in the future, your property costs may change, and as a result, your escrow payment may change. Explains that if your taxes go up, your escrow amount will go up. Loan calculation. This part's really scary, especially if you actually have a mortgage. If you've ever figured this out. You've got your APR, but then you've got your total percentage that's interest. Appraisal, liability after foreclosure, almost everything in Missouri. We are a recourse loan state, so they can still seek a judgment after they've foreclosed on you for any deficiency. That's what this is talking about. Right here on every single closing disclosure, hard-coded in. Questions. If you have a question about the loan terms or costs, use the contact information below. To get more information or make a complaint, contact the Consumer Financial Protection Bureau at, and there's their little URL. So that's going to show up on every single one.
Okay, so if David is 3 days before closing and there's any problems on it at all, whether it be 1 or 2 items that might be wrong, do we have to go back to the 3 days again, the starting period, or can that be corrected within that 3 days?
She asked if there are any problems with it, do you have to go back and wait the 3 days again? The only changes that will trigger that is if there's a change in the APR, which a lot of times there will be if it's a construction loan, for example, an acquisition and construction, and or if they change the loan product, say from fixed rate to adjustable or vice versa, or if they add a prepayment penalty. So those should be the only 3 things that are really going to trigger that waiting period again, redisclosure and waiting. If there are any changes though, it will have to go to the lender for approval. So there could be a little bit of lag time. It may not be, most lenders won't allow you to make changes at the closing table without their approval anyway, realistically. So, I don't know that a whole lot is going to change there, but that's the other thing to keep in mind is they will need to see that, and they may have to enter those changes versus doing it by hand at closing.